Hello and welcome to Macrobytes, the economics and politics podcast from Aberdeen Investments. My name is Paul Diggle.
And I'm Luke Bartholomew.
On this episode, we want to talk about monetary policy, bond yields, and the energy shock, the inflation shock in the context of the Iran conflict. But perhaps we'll start, Luke, by just level setting on where we are in the conflict on Monday, the 1st of June, because markets have become increasingly optimistic over the past week or so about potential diplomatic breakthrough. The US and Iran are exchanging memorandums of understanding. They're perhaps inching towards some kind of a deal, but at the same time, there are exchanges of fire going on between the two sides. And it is still, I think, perfectly possible that they enter into full-blown resumed conflict, even if the base case is that we are progressing to some kind of deal. So market pricing swinging around a little bit. Currently, as I say, fairly optimistic, oil in the low 90s. But all that is having an impact on bond yields and how central banks are priced. So what we want to talk about is differences in the pricing of central banks globally in response to the energy price shock, and how you could sort of justify or not those differences. So why don't you start by sort of outlining some of the central bank pricing?
Sure, yeah. Well, I think, as you said, there's been quite a big difference in how the various different central banks have been priced. And a good way of getting into that is maybe sort of case studies across each of the central banks, and then we can sort of compare and contrast from there. And I think perhaps, given where we're sitting, a good place to start is maybe with the Bank of England and the UK. And it's worth remembering when we think about how much markets have moved as a consequence of the Iran shock that we started the year with pretty high expectations for further Bank of England rate cuts this year as a consequence of the fact that the labour market was very weak. It's been stagnant for essentially 18 months or so, and it looked like inflation was on a path back to 2%. In fact, had it not been for the Iran conflict, it's likely would be back at 2% by now. So that combination of a weak labour market and falling inflation seemed to mean that the conditions were in place for further monetary easing. We'd expect 3 rate cuts at the start of the year. The market was pricing for perhaps a little more than 2, but the point is that a fair degree of easing was priced in to take rates back towards 3%, which I think is most people's assessment of where short-run neutral is. But the Iran conflict led to a big upset in that market pricing. So we went from, as I say, maybe perhaps 2 and a little bit cuts priced in to close to 4 hikes priced in. So a really quite dramatic turnaround in pricing. And I think there were several reasons for that. One, there was this perception that the UK is maybe a little bit more inflation prone than other major economies, that inflation expectations are less well anchored here. And as a consequence of that, when a big inflation shock comes along, it doesn't just stay in the asset price or the commodity price that it hits in the first instance, it spreads wider across a broader range of price setting. And so the central bank sort of needs to get on top of those potential second round impacts. And then related to that and secondary, the Bank of England did seem like it was relatively hawkish at the start of the conflict. There was this big shift in communication, it seemed, where it did seem to suggest that it was worried about those second round impacts, and the bar to hiking wasn't particularly high. Now, since then, market pricing has reversed again, and it's looking like something like 1 hike is priced in this year. So, a significant dialing back of expectations from that near 4 that I was talking about. And the reasons for that are, one, the economy has just been much weaker since then. As I said, the labour market was weak at the start of the year. It does look like it's taken another big leg downward since the conflict began. There was a very large fall in jobs in April. And then some activity surveys as well look like they've deteriorated quite significantly. There was this brief period where they held up surprisingly well, but since then they have taken quite a sharp turn lower. And what that means is that this weakness in the labour market, the weakness in the economy in general, it's quite difficult to see workers and firms having much wage bargaining power and price setting power. So even if inflation expectations might be a bit higher, it's difficult for that to be passed through into second and third round when there isn't that price setting and wage bargaining power. And then second and related to that, again, is that the Bank of England has also done an about course on its communication recently, sounding much more dovish. It's used a sort of scenarios framework. It's leaned quite heavily on scenarios to try and explain its reaction function. But the upshot of those scenarios is basically absent of a further very large increase in energy prices or much more persistence and pass-through in inflation than expected, then the Bank of England thinks it would be appropriate to keep interest rates on hold. And I think a key analytical reason for that is, as I said, we started the year with the market pricing rate cuts, and the fact that the market is now no longer expecting those rate cuts has seen short-term interest rates increase. It's seen financial conditions tightening, and from the Bank of England's perspective, that is enough to do the job for them. They don't have to do any extra tightening on that. It's just the reversal of expectations of potential cuts that will do the job for them.
And in the ECB case, the European Central Bank, there are also rate hikes priced. I think, unlike with the Bank of England, we are expecting those to be followed through on, though. So while we take issue a little bit with Bank of England pricing, as you've laid out, the ECB, I think, is almost certain, slight hostage to fortune, but almost certain to hike rates at their meeting next week. And then there's the possibility of further rate hikes later this year as well. I think a key difference that justifies rate hikes from the ECB's perspective, but perhaps makes them less likely from the Bank of England's perspective, is, well, European economy is fairly exposed to the rise in gas prices. Meanwhile, it doesn't have the same degree of weakness in the labour market that the UK economy has. But I think most fundamentally is where rates sit at the moment. So the ECB deposit rate is at 2%. That is neutral in their telling. The sort of flip side of President Christine Lagarde saying that the ECB is in a good place on policy going into this shock, that it was not going to hike, it was not going to cut, it was happy with where it was, is that when an inflationary shock comes along, hiking is the obvious response. So I think in their case, it's not like a whole load of rate cuts were priced out and that did the work for them. They are going to have to follow through on delivering the rate hikes that are priced into market. So certainly on 11th of June, rate hikes very possible. It could be that they frame that a little bit more dovishly than the market currently expects, sort of in risk management terms, but I also find it quite plausible that maybe another rate hike occurs again later in the year. It'll partly depend on the course of the Iran conflict, whether we do get this ceasefire extension and reopening of the strait and therefore further pressure on oil prices. The other key thing to watch is second round effects, whether there is a bleed through of the energy price shock and the increase in fuel prices, headline inflation that is causing in the Eurozone, into core prices, services prices, a broader range of goods prices. The evidence so far is that there actually hasn't been. And indeed, that's a common feature of the global data, the global inflation data, that for now at least there's pretty limited evidence in the way of second round effect. That might just be that it's too soon to tell, but that's an encouraging development for now.
And then what about the Bank of Japan? Because similarly to the ECB, I think there's expectation that they're going to be increasing rates.
Well, in a way, it's a bit of a flip side of the ECB story, because we came into the year with the Bank of Japan priced to hike. They're much earlier in that rate normalization cycle. They've got, they never really did the post-COVID rate hike, so they're still priced to sort of to do those, to gradually get away from extremely low interest rates, where they've obviously been for a very long time. And then the shock itself has actually caused some of those rate hikes to get priced out, in contrast to the Bank of England and the ECB. And I think what's going on there is that the BOJ was on its very gradual hiking cycle because of signs of strength in the underlying economy, activity side of the economy, affirming in consumption, affirming in wage growth. Actually, the Iran shock is in a way therefore playing out as something of a negative demand shock in the first instance for the Japanese economy, especially because Prime Minister Takaichi, the new Prime Minister, is doing more in the way of consumer support and fuel price subsidies and tax cuts to protect consumers than you're so far at least seeing in certain other economies. So it's not so much in the first instance playing out in prices. Actually, the most recent evidence has been a moderation in Japanese core inflation pressures. It's going to play out on the consumer side, on the demand side of things. So you're seeing some pricing out of rate hikes. Now, I still think hikes are coming in the BOJ's case. Maybe in June, maybe in July, they might get off at least 125 basis point rate hike at that point. Bit of an open question about whether there's going to be any more later in the year. They need more evidence of affirming and underlying wage pressures, I think, to be on a more sustained hiking cycle. But of course, the other big thing that's going on in the Japanese case is profound depreciatory pressure on the yen, on the currency, which has required repeated or triggered repeated Ministry of Finance currency interventions to try and establish a bit of a line in the sand at 160 on the dollar yen exchange rate. And they're not helped in that by the slowness of the Bank of Japan's rate hiking cycle. Key point we would make there, though, is that these interventions, which the Ministry of Finance has a long history of doing to protect the yen, they don't change the fundamentals, right, which are normally about growth, inflation, wage growth, and most of all, interest rate differentials with the rest of the world. They can slow the volatility, they can slow the extent of depreciation in the currency, but they don't change the fundamentals, so that they don't fundamentally alter there is a geopolitical shock occurring. In the first instance, that plays out as dollar strength. I don't think, therefore, that they can really re-establish some kind of appreciatory trend in the yen.
And so then finally on the Fed, which, similar to the Bank of England, came into the year with the expectation of further rate cuts to be delivered. They were, of course, delivering what Powell at the time called insurance cuts at the back end of last year around potential weaknesses in the labour market. There were some concerns that the labour market was getting close to so-called stall speed dynamics, and therefore policy needed to ease as a consequence of that. And then on top of that, again, it looked like price pressures were moderating, and again, interest rates above neutral, and the Fed was trying to be on a glide path back to neutral. So, sort of similar to the UK, albeit from a position of somewhat more economic strength, I think it's fair to say. And then again, the Iran shock came along and I think has disrupted those expectations. The market is now looking for something like 125 basis point hike over the next year or so, partly as a consequence of the inflation pressure that's coming from the big increase in energy prices, but also, again, sort of in contrast to the UK, partly because of some of the US's fundamental strengths as well. The labour market weakness that had been part of the justification for the insurance cuts last year seems to have ended. If anything, the pace of jobs growth recently has been running above the so-called break-even rate. So that's the rate of jobs growth that's necessary to stop unemployment increasing. So the labour market looks quite healthy on that front. And then also there's been very big pickup in AI-related capex, which is having some upward pressure on prices as well. So while the Fed at its last meeting kept its easing bias in place, its easing bias that it's had for some time now, so in principle pointing to more rate cuts coming, and indeed that's what the dots show. These are the dots that show the forecast of the various Fed members. The median dot of that is still pointing to rate cuts. I think that probably doesn't quite reflect where the center of the committee, or certainly the center of the committee as was at in its thinking. I think they are probably in a much more neutral mindset. That is, open to the possibility that a rate hike is just as likely as a rate cut from here.
How's that going to change, though, with the new Fed chair? So Kevin Warsh was sworn in last week in a ceremony at the White House. And that's the first time that a swearing-in ceremony has occurred at the White House. Maybe a sign of the sort of what's to come about the relationship between the Fed chair and President Trump. But it's possible that Warsh would have partly made his pitch for Fed chair on an idea that further rate cuts would be coming under him. So how is that going to sort of make contact with the fact that the committee is in the process of shifting from its previous easing bias to a more neutral bias?
Yeah, well, I wonder if some of the reason the committee has gone so far, various policymakers have gone so far to try and establish this more neutral baseline is in part to level set, to use a phrase there, before Warsh comes in to be sort of that more neutral place, to make it, so that the debate has to start from neutral terms, quite literally in that sense. And what's interesting about the way in which Warsh has gone arguing for rate cuts, and as you say, I think in the run up to his announcement, the various auditions, rehearsals that were happening in public and no doubt in private too, where he was making the case for rate cuts. It was less about those sort of insurance rate cuts that I was describing being the motivation for the Fed's cuts last year. That is to say, the weakness of the economy requires interest rates to be a bit lower. Instead, he was making the argument that, if anything, it was the strength of AI and the productivity growth that was going to engender that meant interest rates needed to come down, that this was ultimately going to be disinflationary, and so interest rates didn't need to be as high because inflationary pressures just weren't going to be there as a consequence of all this productivity growth. I think Warsh might struggle to bring the committee along with that view, to be honest, for several reasons. One, in the short term, I think the assessment of most of the policymakers is that, if anything, AI is a bit inflationary. There's just some weird mechanical ways in which it's doing that, with software prices going up at the moment as a consequence of those being bundled with more and more AI features. The committee might be inclined to look through some of that stuff, but nonetheless, it's coming at a time where obviously inflation is already higher because of energy effects. So perhaps they're a bit sensitive to those kind of look-through arguments. And then more fundamentally, this demand for capital, this demand for capex is also putting upward pressure on prices as well. So that's in the short term. It's more like AI as a demand driver rather than a supply side driver in the way that Warsh wants to describe it. And then second, in the long run, if anything, if AI is successful in boosting productivity, that's likely to push up the so-called equilibrium rate, R star, the neutral rate, which means, all else being equal, over the long run, interest rates will need to be higher, not lower, in response to what AI is doing to the economy.
And another line of sort of attack Warsh might have, or line of argument he could make, and people have attributed this to him, I don't think he's actually voiced it in so many terms himself yet, is that lower interest rates would be a sort of quid pro quo for a shrinking of the balance sheet. So as you shrink the balance sheet and tighten financial conditions, you can lower interest rates and loosen them, and they sort of go hand in hand. And Warsh is famously an opponent of a very large Federal Reserve balance sheet. In fact, that was the subject on which he, in the end, fell out with Chair Bernanke post-financial crisis and left the FOMC first time around, was on his opposition to the very large balance sheet of the Fed. He thinks it involves the Fed too much in fiscal policy. It actually undermines its very independence by running this very large balance sheet, holding so many treasuries, involving itself in fiscal policy in a way. Is that an argument that he might make more progress with the rest of the FOMC? Is it intellectually defensible?
So that kind of quid pro quo argument is maybe something Warsh himself has flirted with. I definitely think it's something that people in financial markets have run with. It does seem to resonate with the way that financial market participants think about how the Fed balance sheet, QE and QT works, and interest rate policy more generally works. But again, I'm not sure it really works with the rest of the Fed policymakers, the people that Warsh really needs to convince. I think a lot of the staff and the policymakers at the Fed think of balance sheet policy at this point as being much more sort of technocratic and about the transmission of the existing stance of monetary policy rather than something that affects the stance of policy in and of itself. Now, that's not always true, and indeed the key belief that these Fed policymakers have is that what you do on balance sheet policy is state dependent. There are times where buying assets or selling assets can have a very big impact on financial conditions, and there are times where it isn't. In fact, it might be largely inert. And I think many of them are of the mind that, broadly speaking, a gentle rundown in the size of the balance sheet would be largely inert on financial conditions in these kind of economic conditions. And I think a big reason that they think that kind of rests on their understanding of whether it's the asset side or the liability side of the balance sheet that matters at any given time. Of course, you can't expand one without expanding the other. The way that QE works is you buy assets, typically treasury bonds, and you do that by creating reserves. Those are liabilities for the Fed. So as you increase one, you necessarily increase the other. And simultaneously, when you do QT, you run down the size of your assets, but you're also destroying reserves as well. And it's one-for-one relationship. But crucially, even though these move together, they do work through different causal channels. There are times when increasing reserves really does have quite a lot of causal impact on the economy, potentially during moments of high financial stress where there is this lack of liquidity. And there are other times when perhaps it doesn't very much. And simultaneously, there are times where buying lots of assets has a big impact on the economy through what it does to prices, the prices of the things that are being bought, and then perhaps other times where it doesn't. But again, crucially, these do work through slightly different causal channels. And I think many Fed policymakers, and I think I would agree with this, would think that you could certainly sell enough assets, you could do enough QT that would in time push up on so-called term premia, push up on long-term interest rates and tighten financial conditions that way, running through the asset side of the balance sheet. But long before you got to that point, at least in the current conditions, the binding constraint you would face would be on the liability side of the balance sheet. That is to say that you would find that you don't have enough reserves in the system. So once upon a time, pre the financial crisis, the Fed used to run a very small balance sheet in a scarce reserve system, and it would sort of deliver its policy rate by making marginal changes in this reserves market. But after the financial crisis and QE, it moved to this ample reserve system, where a key feature is that there's always more than enough reserves to meet the demands of the banking system. So in effect, the reserve market is dead at that point because reserves are just so ample that there's never any need to go into the market to look for more. And so what that means is the Fed has to set policy directly. It administers rates, it's called. But the point is you need reserves greater than the demand for the banking system. And if the Fed were to start running down reserves from here, I think it would pretty quickly get to the point where it didn't have enough reserves to meet that demand. In fact, quite recently, the Fed had to start doing asset purchases again, precisely because there were some strains appearing in short-term funding markets, money markets, that made it look like we were getting very close to that point where there weren't enough reserves to meet the demand. So the point is that it wouldn't take much of a reduction in the balance sheet from this point before you ran into that liability constraint, let alone what it does on the asset side in terms of the constellation of prices.
So Warsh is going to struggle to get this argument that shrinking the size of the balance sheet opens up space for interest rate cuts as sort of a quid pro quo. He's going to struggle to get that off the ground because long before selling the assets, increasing term premia, lowering the prices of those assets becomes the transmission to the economy, which you can offset by lowering interest rates. The binding constraint becomes demand for reserves from the financial sector because they are used to, or they're sort of, the whole setup now, the institutional setup is to flood the system with reserves. There is just structurally very large demand for central bank reserves. But of course, Warsh will well know that. I mean, he is steeped in these arguments about the functioning, the technicalities of the balance sheet. So are there things he could potentially do to reduce the demand for central bank reserves from the financial system, therefore alleviating the constraint you point out, giving him room to shrink the balance sheet and therefore lower interest rates as an offset?
Yeah, so there are definitely things that can be done to shrink the extent of demand from the banking system as things currently stand. Stephen Moran, who was Fed governor until recently, his seat has actually just been taken by Warsh. He may be coming back to the Fed in the not too distant future, as and when there's some more turnover in the seats. Recently wrote a paper and then gave a speech about potential ways in which demand for reserves could be brought down. And essentially the key point is that the demand for reserves is a contingent feature of the regulatory environment, the liquidity conditions, to an extent some of the behavioral features that banks have got used to in the post-financial crisis period, but those are not immovable. You could change things around banking regulation, Dodd-Frank. You could change things away around which liquidity tools are accessed. You could encourage a change in behavior, make it so that when liquidity tools are accessed, that's less scarring for financial institutions to do that, sort of change the culture around accessing these things. And that would, I think, bring down the amount of reserves that the banking system as a whole wants to keep, and thus creating space for you to sort of reduce the size of the balance sheet. But we're not talking a radical reduction here. We're not going to get anywhere close to the pre-financial crisis kind of level. So there is a relatively modest change in the size of the balance sheet, and that, might be enough for Warsh. I think, to reduce it by a couple of trillion isn't to be sneezed at necessarily. But again, the crucial thing is that the structure of interest rates isn't one of those things necessarily that would reduce demand for reserves. Cutting interest rates won't do that. It's much more on the regulatory side of things. So this question of what you do on interest rates and what you do on the balance sheet are to a large extent quite separate questions at the moment, and it's going to take quite a lot of work on the regulatory side to get us back to a point when they can be connected questions again. So for now, there's a lot of work to be done before I think Warsh is able to convince anyone at the Fed that this is a reasonable quid pro quo.
And then a possible risk he could run in the meantime, were he to press ahead with shrinking the balance sheet nonetheless, without sort of laying the ground, rolling the pitch by making these regulatory changes that reduce demand for reserve, a possible consequence is pressure on the long end of bond yield curve. So you could see a rise in long-term bond yields as a result of the Fed shrinking its balance sheet, potentially. If investors sort of get worried about some of these dynamics. More broadly, of course, during the Iran conflict, during the energy shock, there have been points at which bond markets have been selling off aggressively. Now, as we talked about at the start, not for the past week or so when optimism has increased, but certainly at times when there's been upward pressure on oil prices, you have observed a pretty tight correlation with bond yields as well. And of course, there's other things going on in the global macro. There's UK politics, there's concerns about Japanese debt sustainability, there's all sorts of things that have at points put upward pressure on bond yields. And a very common question that we get in this context is, well, what does it mean for equities? Because, of course, equities have been remarkably resilient during much of the energy shock. That's partly been because of sort of hopes of its eventual resolution. But there doesn't seem to be this sort of like tight connection between a sell-off in the bond market and a sell-off in equities. So why not, when does a rise in bond yields become more problematic for equities? I think I'd really make three key points in answering that. First, it's not the level of bond yields that necessarily matters. There is no magic threshold, say 5% on the US 10-year or 6% on the US 10-year, above which suddenly you get big problems rebounding on the economy and on equity markets. I would resist this idea of certain prices just cause non-linear effects in general. Instead, I think what matters is the cause of the sell-off in the bond yields and the speed which is happening. If the cause, say, of a sharp rise in bond yields were really strong demand in the economy, the strength of underlying demand, well, all else equal, that's a good thing for growth and for equity markets. And maybe that's a little bit of what's going on, as you talked about early on in the context of the US and the Fed. There is actually a very strong positive demand shock coming from AI capex build out. But if the cause is a negative supply shock, a sharp upward move in energy prices, raising inflation, well, all else equal, that's a headwind for the equity market. In this case, it's sort of both. So it's not necessarily obvious how that's all going to shake out in pricing. And then the other thing is the speed. Generally speaking, the market seems to be able to absorb, the equity market seems to be able to absorb gradual moves in bond yields up or down. But what you see is a sort of inverse smile, a sort of frown effect, if you chart it, where very large moves in bond yields, either higher or lower, are associated with weaker equity markets. And that's often when you get sort of dislocations in the market, where the speed of moves just seems to be too rapid, and it unnerves investors. It causes perhaps issues in the financial plumbing as well. And notably this time around, even at the most acute points of geopolitical risk during this conflict, the bond market never looked particularly disorderly. So measures of liquidity or stress, the move index of bond market volatility never looked particularly strained. So all else equal, that would sort of make sense of why you've not yet at least seen this contagion from higher bond yields, lower bond prices, into equity markets, and you've actually had a degree of resilience, or quite a lot of resilience throughout that.
All right, well, that is all that we have time for this week. Please do feel free to give us feedback. And as ever, please do like and subscribe wherever you get your podcasts from if you have not already done so. And then all that remains is for me to thank you all for listening. So thanks very much, and speak again soon.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment, recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.